So one way of reducing the equilibrium output is to use taxes. So what we're going to do is just have a little bit of a look at taxes for this one and show how they work on the diagram. I'm going to focus on the external cost effects of taxes, how we correct the market failure. It's also the case that you need to understand how the government can raise revenue from taxes, and that's in a separate clip that will appear after this one in the list. So in terms of taxes, there are two broad types. There are direct taxes. Direct taxes are paid by you to the government. So they go directly from the individual to the government. And these tend to be taxes on income and wealth. So the obvious examples would be income tax and corporation tax. Tax on company profits, tax on individual incomes. So the other type, they are called indirect taxes, and they're the ones that we're interested in today. They're indirect because the way it works is that you, the consumer, you pay the firm. The firm then pays the government. Effectively, and the key point here is it's the firm that actually directly pays the tax to the government. It's indirect because effectively the firm will push some of the tax onto you, but it's the firm that pays the tax to the government, not you. And that's not directly. You pay the tax to the firm pays the tax to the government, but the government will hold the firm responsible for paying the tax. And that's very, very important for understanding how diagrams work and so on, because effectively we're saying that firms literally pay indirect taxes, and therefore an indirect tax, what it does is it leads to an increase in firms' costs. It leads to an increase in their marginal cost. Because if the government decides to tax these pens by 10 pence each, the firm, for every pen it makes and sells, it now has to pay the government 10p. Its costs are 10p per unit higher than they used to be. And that's really, really important you understand that. So although the firm may pass some of that tax on to me, the government at the end of the year will come to the firm and say, how many pens have you sold? Give me 10p for each one. So it's just the same as like the plastic. In order to make a pen, the firm needs to pay for the plastic, but in order to make the pen, the firm now has to pay 10 pence to the government. It's really important. So indirect taxes, they come in two types. So they further subdivide. We talked about direct tax a minute ago. Indirect taxes. So these are taxes on expenditure. That's the key point behind them. And there are what are called specific taxes, and there are what are called ad valorem taxes. A specific tax is a certain amount of tax per unit. So that's, say £5 per unit. It's a specific amount. £5 per unit or £10 per unit, something like that. An ad valorem tax is a percentage tax, like VAT, which currently stands at 20%. And the impact of these two things diagrammatically is different. If you take a specific tax is very straightforward, because all we're saying is that let's suppose we're taking a £10 per unit tax. Well, essentially it's just adding £10 onto the firm's costs. So whatever the firm's costs were before, they're now £10 higher. So if we take the 10th unit there, let's suppose that one used to cost £20 to make. Well, now in order to make that unit, it costs another £10. It's now going to cost £30. This unit here, maybe it costs £50, now it's going to cost £60. So the whole marginal cost line moves to marginal cost plus £10. whatever the cost was before, it's now £10 higher. It's now £10 higher. So supply shifts vertically and parallel. Yeah, it's simply a higher level of cost. Or if you want to look at it a different way, at a given level of price, the firm will no longer be able to afford to supply as many units. If we were to take an ad valorem tax, then they work slightly differently. Yeah? I'm going to imagine, I'll do it on you. What we're going to do is we're going to imagine the government goes mad and decides that VAT is now going to be 50%. And let's see what that does to the firm's costs. So there's supply, which is marginal cost. Let's take this unit here. We'll call that one the 10th unit. And let's suppose that at the moment it costs the firm 20 quid to make it. Well, now, when the government imposes 50% VAT, it's now going to cost it 30 quid to make that same unit. So its marginal cost is now at point A. But as we move further along, if we look, say, here at the 30th unit, originally it cost the firm £40 to make it. Well, 50% of 40, half of 40, is 20 quid, not 10 quid. The higher the price, the higher the tax. So here, the tax is £20. So, the firm's marginal cost is 60 quid. And up here, for the 50th unit, where price is 60, the government would then charge 50% of 60, which is £30. Yeah, so there the tax is £10, there it's £20, and there it's £30, depending on what the price is. And as a result, the supply curve shifts. It pivots. Yeah, it shifts in a non-parallel fashion. Yeah, they diverge. Yeah, so the impact of the tax, depends. So the impact of an indirect tax depends on whether it's specific, which is a certain amount per unit, or ad valorem, which is a percentage tax. But what we're trying to say is, well, what is the purpose of these taxes? So if we go back to a market failure diagram, what we know in both of our market failure diagrams is that we have overconsumption. Let's take a consumption externality, a negative consumption externality. We know our base diagram then looks like this. We've got demand, which is marginal private benefit. We've got supply, which is equal to marginal private cost and marginal social cost, because we said that the externality is only in consumption. The equilibrium output is there. Because it's an external cost in consumption, the marginal social benefit is only there, so the socially optimum level is there. SOL, socially optimum level. So we need somehow to reduce output from there to there, and our problem in this situation is that there is an external cost of that amount. And the solution, therefore, is to impose a tax. We use an indirect tax, and the goal of that is to internalise the externality. So by making someone actually pay for an amount of money equal to the external cost, it now becomes, instead of becoming an external cost, it becomes an internal cost, because now producers and consumers have to take it into account, because one of them, or both of them, is going to end up paying it. So if we impose a tax equal to that amount, then the supply curve will shift vertically, by the amount of the external cost. So basically we're setting the tax per unit equal to the external cost per unit. So therefore the whole supply curve, it shifts vertically by the amount of the external cost. And of course what that means, that's ST, which is marginal private cost plus the tax per unit. What that means, is that instead of being in equilibrium at A, the market is now in equilibrium at B. Prices are driven up from P1 to P2, and as a result, output falls to the socially optimum level. And therefore, the welfare loss is eliminated. originally we had a welfare loss, because we'd gone past the socially optimum level. The original welfare loss was the difference between marginal social cost and marginal social benefit. That was the welfare loss, because the social benefit was less than social cost. But that's no longer true because the equilibrium output has fallen, from the equilibrium level to the optimum level, and as a result, the tax in principle has corrected the market failure. In terms of whether this is a good solution, well, we can say, kind of what's good about it, is it makes the polluter pay. So the person who's creating the problem has to pay for it because we set tax equal to the external cost. It should correct the market failure. So the welfare loss is eliminated. And of course, what it also does is it generates tax revenue for the government. So the government can then use that revenue, to, I don't know, if this is tax on smoking, it could use the tax revenue to advertise or to, kind of anti-smoking campaigns and so on and so forth. So it's both economically sound in the sense that it internalises the externality and it raises additional money. The problems, of course, with these sorts of things, is that, one problem is it's very difficult. It's very difficult to calculate the external cost. So it's really hard to know, what is the true cost of litter or climate change, and nobody really knows. So therefore, getting the tax at the right level is very, very difficult. Secondly, it's what's called regressive. All indirect taxes are regressive, and taxes on smoking and alcohol are particularly regressive. Regressive means it takes a bigger percentage of someone on a low income. So it takes a biggest percentage of the income of somebody on a low income, than someone on a high income. And the reason for that is that if you imagine two people, a rich person and a poor person, the poor person is probably spending all of their income. So if you tax spending at 20%, effectively you're taxing their income at 20% because they're spending all their income. A rich person, let's suppose they're only spending 10% of their income. If you now impose a 20% tax on spending, it only affects that 10% of that person's income that they're actually spending. The effect is much, much smaller. So indirect taxes tend to be regressive, and it's particularly true for smoking, which is much higher amongst low-income groups. Generally smoking is inversely correlated with education. The more educated you are, the less you smoke, and also the more educated you are, the higher your income tends to be. So that's a bit unfortunate. Obviously also, there is a risk, that it's inflationary. It drives up prices across the economy and might make people ask for higher wages. So these are the sorts of things that you want to take into account when looking to evaluate this type of policy.